Afternoon, ladies and gentlemen. Thank you for taking the time from your lunch break to join us here at DBS Treasury's online investment seminar. We hope at the end of the session, we will leave you with some food for thought and better yet, some actionable insights on what to do with your money. I'm Chen Yan from the Asian Insights Office, part of DBS Group Research Department, and I'll be hosting this afternoon session. With me in the studio is a very special guest and seasoned expert from the investment industry, Mr. Ng Su Nam from Columbia Threadneedle Investments. Columbia Threadneedle is an asset management group with a global footprint managing some $650 billion worth of assets across developed and emerging markets. Sunam is the head of their Asia Equities division and has decades of experience in the fund management industry, focusing on the Asia-Pacific markets. He's here to help us make sense of the turbulence in the markets and, more importantly, his advice on how we should respond to it. But before we begin, just a quick housekeeping note on how you can participate in today's seminar. If you're viewing us on your computer or tablet, you should see the Q&A box on the right column of your screen next to the video player. Now, if you have any burning questions during the main interview session with Sunam, please feel free to type them into the Q&A box which says enter your questions here. You can also vote for questions posted by other viewers as well. We'll attempt to answer as many of these questions as we can. And for those tuning into us on your mobile phone, you will have to stop the video and switch into our website in order to pose your questions. Finally, during the interview, we will also be seeking your opinions on some of the topics touched on by Sunam, and it will be interesting to see what your collective thoughts are, the wisdom of crowds, as it were. I will let you know when the poll appears. Now, as part of our constant effort in ensuring our research content and insights are relevant to you, we have reached out before today's seminar to find out what are some of the key issues and topics we should cover during the interview session. We have received hundreds of responses and questions from you. Now, if I may organize them a little, they fall broadly into three categories. Firstly, there's a preponderance of queries on China and where it is headed economically, and what are the key risks we should be paying attention to. Secondly, what are the key drivers to market sentiments these days? Where is growth coming from, and where is the oil price headed? And finally, where will you place your bets in Asia? These questions are interrelated, and we will deal with all of them during the course of the discussion with Sunam. So let me start off with what's on everybody's mind, China. Sunam, why all the negativity on China? Are the fears going to pan out? Is China facing an imminent crash, as many fear?
Well, I think indeed there are a few ongoing issues. I think at the top of my mind, problems in the banking system, non-performing loans, excess capacity in some sectors, and of course corruption. But I think these are not new issues. They're issues that the central government has been tackling for a while, and in many cases with decent success, especially since Xi Jinping came into power. His anti-corruption drive, for example, I think that has restored a lot of party discipline. And that is important because it has far-reaching implications on fiscal discipline and accountability, which, in my view, is the root cause of many of the problems with excess capacity in the economy. Now, apart from this, I think the reforms that they are driving are also very positive for the medium to long term. Reforms across a wide swath of issues, ranging from financial liberalization to improving the way SOEs are run, and around the whole mindset of how they are managing the economy as well. I think it's a hugely challenging task for an economy as large as China, but observing them over the last few years, I think they have displayed adequate understanding of the issues, as well as an ongoing capability, decent ongoing execution around a good game plan. So I think what is also encouraging is the fact that they have taken on a sustainability mindset, and in terms of driving reforms, they are not also pushing it beyond what the economy can take. So I think, short of a policy error, I do not think there's an imminent crash. And I think that the recent reaction in the marketplace is just overly extrapolating some of the negatives around China.
Well, you have a lot of confidence, it sounds, in the Chinese central government. You point to their track record. Yeah. You think that they are addressing the crux and also the root of the problems that have led to some of the symptoms that we see being reported. But the market seems to feel differently. I mean, what we read in the headlines. So people are still concerned, and in particular, they have pointed out that the health of the financial sector and the banking sector in China is of particular concern. Do you think this mounting bad debt that we read about is going to cause a larger kind of widespread problem economically for China?
Well, I think the bad debts in the banking system, the Chinese banking system, has been there for a while. Back in 2011, for example, the LGFV debt crisis. I think at that point in time, I think the authorities have. I think they have the inadequate understanding of the issues in the banking system, and therefore I think the dangers were even more severe. But I think since then they have done what they have done to diffuse the LGFV debt issue, and yes, there are always going to be new non-performing loans emerging. This time round, perhaps in some sectors like mining, for example, because of the slide in commodity markets. But that's the case for banks elsewhere in the world. I think Singapore banks, for example, I think we will see some uptick in non-performing loans as a result of that as well. So I think the profits in the banking system may be affected, but I do not think that this problem is as severe as that in 2011. I think they have a better grasp of the situation and what is needed to prevent a meltdown. And in the past, they've always shown this ability to be ahead of the problems, so as to prevent, so as to prevent a more dire situation from developing.
You said that the crisis they faced before was worse, but some have pointed out that the recent proposal for debt equities swap for the bad debts that the banks have had actually reflects the poorer credit quality of some of these debts instead of how they have done so in the past, where they kind of securitize this and use asset management firms to kind of pass them down. So what are your thoughts on?
Well, I think the debt equity swaps are not new around the world. It's just that China is just late to it, right? So I do not think that this additional mechanism reflects the more severe problems in the system. In fact, this is now allowed. I think just add to the tools that they have available to help get rid of some of the non-performing loans in the system. So I think this is a good development. Okay.
So your confidence in the authorities doing the right thing, you think they have a game plan which they're trying to implement. On that point.
Yeah, but I'm not dismissing all the risks, though. I think the risks are there. I think the question is really about how you think they have been tackling it, as I mentioned earlier on, and for stock market investors is also about what has already been factored into the market. Now, in January, I think there were some new incremental negatives, like, for example, the uncertainties around the renminbi, and of course the slide in crude oil. But to me, the market overreacted to these issues without considering how, over the course of time, this may play out. I mean, you look at the renminbi, it's only a very small depreciation against the USD. And the Chinese government still has substantial control over the final outcome. Yeah, but the market overreacted because of the prevailing uncertainties that has been ongoing for a number of years. But to me, this body of negatives, so to speak, prevailing negatives, they have already been discounted to a large extent by the marketplace.
Okay.
Yeah.
Okay. But given the underlying kind of analysis from where you're coming from, so a question to to you in relation to the recent announcement by the government of achieving a 6.5% to 7% GDP growth for China in 2016. But before you answer that, I'm going to pose this question to you viewers out there as well. So if you go to the Q&A box you have on your screen, look for poll 1. Click on that and you'll see the question appearing on your screen. Do you think China will achieve their growth target of 6.5 to 7% for 2016? Yes or no? So turning back to Sunam, what are your thoughts? Can they be believed?
Yeah, I think there are a lot of cynicism around this range. But there are evidence and arguments that support both answers. Yeah, but this 6.5% is not too far away from what the market was anticipating, and also coming from 6.9 in 2015. So we are talking about a continued slowdown, which I think is reasonable. You're not talking about an acceleration in growth. And it's also, the pace of slowdown is also in line with the rate of deceleration in the last 3 years. So I would think that it is reasonable and it is achievable. I'm also basing my judgment on my assessment of the new mindset that I alluded to earlier on, and the execution ability of the leadership. I think over the last few years, they have started to focus on sustainable growth rather than high growth, and therefore refrain from the attempting to stimulate the economy more vigorously. So in that regard, I think they probably have some additional measures that they can pull out to help push the economy above 6.5% if needed. And I think more important than the quantum of growth is also the fact that I don't think companies in China will be surprised by 6.5% GDP growth. I think the whole market is expecting that deceleration. So as long as companies are not caught by surprise, they calibrate their business plan and their budgets on the right assumptions, then I think 6.5% still represents a strong level of growth, and a fair level of growth that you cannot get probably elsewhere in the world.
Like you said, so do you see the 6.5 to 7 kind of a secular trend given where China is in terms of its economic development and trajectory?
Yeah.
Or do you see that, or rather perhaps the question is, where do you think that will be coming from? What will be kind of powering that growth, given the fact that, as we have kind of pointed out, and I'm going to kind of beat the kind of bearish sentiments in terms of the banking sector slowing down, a lot of SOEs are slowing down as well, and then some of the key sectors in construction and commodity energy are all kind of slowing down in China. So where do you think that push to kind of give it the 6.5 and 7% is going to come from?
Yeah, I think it's about if 6% is a strong level of growth, then how do you reconcile that with all the negativism around China? I think the 6.5% is an average number. Yeah. So if 6.5% is an average, and there are a lot of sectors that are in excess capacity, not growing, then obviously there are some sectors that are growing even faster than 6.5%.
Right.
And among the listed companies that we look at closely, we can comprehend that, because in sectors like your online companies, Baidu, Alibaba, Tencent, they are growing quite tremendously.
Right.
Yeah. So unemployment hasn't been a problem, millionaires are still minted every day in China. So I think to reconcile that, right, I think will probably bring us to recognize that in China there are still a lot of sectors that are growing quite well, and these are the sectors and companies that continue to drive the economy forward. Yeah, so I think what is important, therefore, is for us to recognize that and not be totally discouraged from participating in the marketplace. But it also means that in an economy that is like running on two tracks, right? There's going to be volatility because there's going to be negative vibes coming into the market all the time to affect market sentiment. And it also means that ETFs may not work as well as in the past, because not everything is going to go up on an even keel. Yeah.
But you mentioned online being a clear example, and I'm sure all of us are fairly familiar with the likes of Alibaba, Tencent, Baidu. But are there any other sectors? Because I remember you mentioning to some extent the shift in consumption also will benefit other sectors within China as well.
Yeah, I think the consumer is always changing, and the consumption patterns will change with the level of affluence. It also changed with your lifestyle as well, and with rapid urbanization, the things that are typically demanded by urban population, like wealth protection products, and the agency force among the insurance companies that we monitor have been growing. So there's also that market education that goes in. So I think obviously some consumption goods are not doing very well, but in recent quarters, for example, we've seen like consumer insurance products selling very well in China. Now, that doesn't quite gel with the poor performance with insurance stocks of late, but part of that poor performance reflects their investment in the A-share market, for which in the second half last year they have to take mark-to-market losses. But the underlying business momentum is really growing quite strong.
Right. Thanks so much to them for kind of interpreting what's happening in China in terms of both the negative news and also some of the official announcements that's coming up. It's good to hear that, given your years of experience, you think that they are on the right track. At least the central government is strong, is addressing some of the key fundamental issues that have led to some of these problems in which the market is picking up to be kind of signs of worry. But the general kind of direction, you still feel that is kind of headed in the right direction.
Yeah.
So, okay, let's move on to the next burning question that is also kind of feeding or fueling the markets in terms of its anxiety. A seemingly simple but a complex one, underlying the movements in that sense in terms of oil prices. But again, before we hear from you, this is another poll question for the audience. I want to turn your attention to the Q&A box. You will see a poll tool. Click on that. Where do you think oil prices will be headed in the next 6 months? Less than $40, between the range of 40 to 60, or more than $60? Sunam, please.
Yeah, maybe I'll enlist the help of a 5-year chart for crude oil. Yeah, so this chart shows you the crude oil price movement over the last 5 years. As you can see, it has been moving around the $80 to $110 channel for quite a while. Let's call this the oil price channel, right? The oil equivalent price channel. And then in mid-2014, there was a sharp sell-off, and you see the sharp price decline. Now that was primarily a supply-side problem. Shale oil and shale gas coming into the market. Now, along that 5-year chart, demand hasn't been a problem. So I think for us for the market to find a new equilibrium channel, let's say between 40 to 60, I think the supply-side response has to come in. Now, supply-side response take time, because even if the new investments are no longer making a decent profit and those stopped, right? I think existing fields will still keep producing because the cost has already been sunk. And so as we chop time, then you also allow more time for supply-side response to kick in. And it seems that at the beginning of this year, the market was trying to find a new channel of between 40 to 60. But of course, in January it dipped below that. Perhaps because of speculative selling, but you can see that it has been attempting to creep back into that channel again. So I hope that helps. But I think time is on our side though, because at below $40, I think a lot of the marginal fields are not making any money. At 45, I think there will be a lack of new investments. So as long as demand side don't come in to be a problem, then I think the supply response should, in the good course of time, come in to bring us back into a more stable channel.
Right. Thanks, Sunam. So we're trying to cover. So we've talked about China. There has been a cause of concern for people. Oil price, which is obviously another, or rather the volatility and what seemed to be a downward trend in oil prices, but then it seems to be moving at now, stabilizing in this 40-60 range. The other thing that has been kind of affecting market sentiments, as it were, is also the movement in the yuan. In relation to that, there seems to be some uncertainty in terms of where the central government of China stands on this, liberalizing on one hand, but then seemingly intervening in the market as well. So where do you think the yuan is headed in the near term?
I think perhaps we need to dial back a little bit further in time to try and figure out this question, the answer to this question. As you know, the PBOC has been able to, perhaps should I use the word engineered, a gradual strengthening of the yuan against the USD for quite a number of years, until 2014, when they decided to allow it more fluctuation and also some weakening against the USD. And since the beginning of 2014 to now, I think we've seen not more than 10% weakening against the USD. Now, this compares quite favorably with some of the declines that we've seen. For example, in the euro and in the yen. The euro, for example, for the 12 months to March 15, they depreciated more than 20% against the USD. So in the larger context of things, right, I think the renminbi is still a very strong currency. Now, of course, there's been recent concerns. So perhaps I'd like to pull up maybe the 1-year chart for the renminbi to take us to maybe our next discussion. It's the wrong slide.
The slide before?
Before that? Yes, this is the right slide. So this is the 1-year chart. And they've been able to manage it against almost flat line against the USD until about August, when they decided to allow a 3% depreciation. I think that coincided with, the timing of when they want to, of their anticipated entry into the IMF SDR basket as well. Now, that triggered quite a number of concerns, right? I think first and foremost, I think people are worried that the Chinese government is no longer able to manage that level, the level against the USD, and also their willingness to manage the strength of the renminbi may also be waning because of competitive, because they want to go about competitive devaluation. And towards the end of last year, the selling pressure got a little bit more severe, and in the beginning of this year, you see another 1.5% drop in January as well. I think part of that is experimentation with a new currency management regime, basically trying to find a level against a global currency basket rather than just the USD. But look at what happened after that, right? The renminbi clawing back all its losses year to date, right? So I think there are perhaps two insights that we can draw here. I think the first is that they may experiment with trying to manage the currency regime better. Right. And there's a lot of arguments why it just shouldn't be managed against the USD, but more against a currency basket like what Singapore do, right? But when it starts to affect confidence, then they quickly come in and wrestle back control as well,
Right.
which I think is a good thing, right? Because that's the major cause of uncertainty for the slide in equity markets, especially in Hong Kong. So the second insight is perhaps on competitive devaluation. So competitive devaluation, I think, is just not the policy intention here. So I think going forward, I would say that the government will still allow for some fluctuation, but I think within what they can tolerate. That means within that which do not destabilize. I think as to the quantum of what that means, I think it's hard to determine at this moment, but the government probably would not know as well. But I think through experience they will find that level, but they will find that level of fluctuation which I think will not destabilize the economy.
We've talked a fair bit about China. How about the rest of Asia in terms of how the other Asian economies are kind of reacting to these global movements?
Yeah, I think of course when the Chinese economy is slow, everybody is affected. But I think across Asia, I see not an even picture again. Like for example, in Indonesia, the politics is getting a bit better, and with that, policy implementation as well. So there's some positives going on there. Also for Malaysia and Indonesia, markets have dropped quite a fair bit. So as an equity investor, I think there's also some attractiveness in terms of value. I'm still concerned about politics in Malaysia, so we're not there. In Thailand, I think the government has also brought in some technocrats to help run the country, so I think that is good. And of course, in North Asia, the tech cycle is still quite important. So I think there's a lot of company specifics that we need to look into rather than buy the country on the back of the economic arguments, the broad economic arguments. So in India, I think they have disappointed on reforms, and of course the market has reacted to that. But in terms of valuation, I don't think it has been cleansed of prior optimisms as well. So I will be more careful on India.
Okay.
Yeah.
So, given what you have said so far, your kind of your analysis on China, that things may not be as bad as it seems. Still, across Asia, like you said, a fairly mixed and unbalanced picture.
Yeah.
So, in this scenario, where would you kind of put your money in which market and which sectors?
I think that there are still a lot of growth sectors, as I mentioned. I think in the new economy sectors in China. I think in terms of stock picks, if you're a good stock picker, China is still the most fertile market. Singapore is not. Even though I think Singapore is a more stable market. You can get it very wrong with the wrong stock in China. You can still get it wrong with the wrong stock in Singapore as well. But I think at least there's a lot more transparency, and there's a lot less heart that can detract an investor. But even in places like Singapore, I think there is a case for putting money into the equity market as well. It doesn't mean there's no growth, then there's no reason to invest in equity markets, because we don't just invest in the equity market for growth. We invest to avail ourselves of the earning stream. As an equity investor, I earn a part of that, and if they are streamed back to me as dividends, then that is a very tangible the return that I'm getting. So in Singapore, companies are pretty resilient in terms of earnings generation. In places like China as well, we are finding in some cases, even while the economy is slowing down, actually the cash flow generation has become better. Because a lot of these companies, they are investing less. Because as the economy is slow, there are less attractive opportunities out there, but their earnings is still holding up very well. And these some of these companies may be streaming back a better dividend yield as well. So in this environment, I think there's still a lot of volatility, and I've been proposing to investors, for example, that they should create a balanced mix of returns that they are getting from the equity markets. A balanced mix comprising dividend yield out of this resilient earnings generating company, as well as the other side of it is capital appreciation, because out of the volatility, there can be a lot of the good buying opportunities. At the same time, if you are in a position to pick the high growth companies as well, there's still that medium term, long term growth story in a still a pretty decent growth environment, anchored by the 6%, 6.5% in China.
Okay, all right. Thanks so much, Sunam. So as we've been speaking and talking, we've actually been getting a lot more questions from our viewers out there. Let me turn to that and perhaps get the viewers to ask you questions through me. Let's see. We spoke about Singapore briefly. So there's a question here on basically where you see the next growth area for Singapore is going to come from, and the region.
The next growth area in Singapore, I think the next growth drivers for Singapore may be different from the next growth driver for the Singapore market. Because I think right now the Singapore market is dominated by the banks, and property is a big part of it as well. Whereas I think the Singapore economy going forward has to be driven by more than just this. I think in the recent budget, there are certain measures to try and help create the drivers for the next stage of our economic growth. But I do not necessarily think that these are the same as the drivers for the stock market.
Okay. We have several questions here around currencies. You spoke about the yuan and the US dollar, but more specifically here, the question being, will the currency yuan be good to hold and keep for the long term as compared to the US dollar or the euro? And then what about the Sing dollar? Will it depreciate against these three currencies in the shorter and longer term?
It's a very hard question, and given the fluctuations in currency markets, like I mentioned earlier on, 20% decline in the euro within the 12 months to March 15. It's very hard to look longer term for currencies. Now, it's easy for me to look longer term to buy into a company and trying to figure out how say Alibaba or Baidu may grow in the next 3, 5, 10 years. But currencies, I think, a bit tougher. But I think that the US dollar has been strong. I think a lot of it driven by investment demand as well, because people are fearful of holding other currencies. And in Europe, QE is still ongoing, right? Whereas in the US, the Fed has already made its first move. The second move maybe sometime this year. I don't know whether it's first half or second half, but just the different monetary policy cycles, I think, suggest that the US dollar will probably be the safer place to be in. But at the same time, if you are talking about longer term, I don't know how far the US dollar can strengthen before the US economy start to feel the pressure of it.
Okay. I mean, a lot of the questions here have been covered by you in terms of where will you place your bets in Asia, which sectors, which industry. You've touched upon quite a number of them, but there is also a lot of interest around the issue of given that we're in Singapore, the issue of property. Let me call up that question and okay, with specifically on property, with all the talk on the slowdown in China, which you have addressed, and even here in Singapore, is the local property market still something investors should be looking at, or where else should they turn to if not?
Yeah, I think there's the residential property market, then there's the other markets that are represented in the stock markets for which you can access through your stocks. I think in terms of residential property market, I think it's tough because of the the government taxes, right? I mean, if I want to buy a third property, it's a 10% tax, and the second property is a 7% tax. I think that just will put a lot of people off. But if you look at the stock market, especially at the REITs, now that's a sector I'm positive about, because I'm still looking at more than 5% yield.
Right.
So you are confident about the property that they own in the portfolio. Yeah, and some of them, I mean, it's not difficult to figure out. I mean, as Singaporeans, we visit the malls that are in these REITs, like Vivo City, for example. So if you are confident about the rental stream, yeah, then that year is interesting.
Thanks, Sunam. Again, questions for a lot of interest around this question, again, centered around where you would place your investments, but more specifically, what's your advice for retail investors seeking capital preservation and passive income?
Well, I think I think it depends on the degree of which you value these two, right? I think capital preservation, if you want to be absolutely safe, then you're not going to get a lot of passive income because interest rates are so low. But like I said, if you can take a little bit more volatility, now that doesn't necessarily mean losing money, because volatility, if you don't liquidate at the wrong time, it doesn't mean you have to take that loss. Yeah, so if you're confident about the earnings stream, again, I go back to resilient earnings stream, right? And if that resilient stream can support an ongoing dividend payout, then if that is what you are interested in, and you are confident that that can persist over a prolonged period, say 5 to 10 years, or even 20 years, then I think if you are interested in collecting that stream of dividend yields as passive income, then you don't really need to worry about the volatility around the stock. Yeah.
Okay, so I'm going to ask you direct questions through one of the viewers, down to the specific. So what's in your portfolio for 2016?
What's in my portfolio? I think my personal portfolio or the fund. I think the fund, we hold diversified earnings. I think we are quite high conviction investors, holding portfolios of maybe around 50 stocks or less. Now to do that, then you are really in a position whereby you want to pick the high growth sectors. So we are still finding China to be very attractive. In our portfolios, we have the new economy sectors and the leading players in that, Baidu, Alibaba. We have a company called NetEase that is the second largest online gaming company in China. In Singapore, we have DBS Bank. I'm talking about stocks that we own in the portfolio, so that's public information. We like it for its resilient earnings stream and very decent dividend yield. We are also overweighted the REITs, for example, again for the dividend yield. So we have been on this argument that in this volatile environment where growth is slowing, there's more uncertainty, we should be calibrating a good mix of the returns coming from dividend yield and capital appreciation. Yes, and in one of the funds that we manage, we actually actively calibrate that mix. Yeah, the Track Ninja Develop Asia Growth and Income Fund, because at different times you can get more attractive proposition
right.
coming from either one. So that has worked out very well for us. Yeah.
So I see you're still kind of exposed to Singapore, as you mentioned, in the REIT space, and China, you're still fairly kind of vested in that market as well.
Yes, and very selective in that. Yeah.
Okay. Again, interest around, well, I mean, similar type questions all around, what would you be kind of putting your money in? And again, let me kind of switch back to, you talked a lot about the Asian equity. I know that's your main area of expertise, but there's also interest on what you think of U.S. equities in the second half of 2016, and how does that kind of compare with the region?
Yeah, in the second half, I think it depends on what is the end point in the first half, because we haven't done the first half. We're not done with the first half yet. But I think one of the things that we have to take note of, I think, first of all, is, as I mentioned earlier on, about the strength of the USD. I mean, what does the impact of that have? What is the impact that will have on some of the earnings of US companies, particularly those with like the earnings outside of the US. Then, of course, the Fed rate hike. Now, the next Fed rate hike, when that's going to happen. If it happened in first half, I think the likelihood is that we might probably get one more in the second half, but I'm not looking at it happening in the first half though. But if it would happen, you would suggest the economy is growing stronger, or something would prompt the Fed to do it. But in any case, I think the probability of a hike in the second half is actually, to me, quite high. So one has to be aware of that. But of course, I think valuations-wise, I still find Asia more attractive. Okay. For obvious reasons, because people are pessimistic, right? So.
Speaking of pessimism, and then also and also the kind of the banking sector as a whole, in which there was earlier kind of sell down on, but it's kind of picking up again. There's a viewer out there who wants to know your opinion on where do you think the bank stocks are headed in the medium term in the Japanese and the Chinese H-share market?
I don't cover the Japanese stock, so I will refrain from commenting there. Now, with regards to Chinese H shares, I would think that earnings growth is not going to be great. I think at best flat, maybe even declining if you want to be a little bit more conservative. But that doesn't mean that earnings is going to collapse. I think there will still be earnings. As I mentioned earlier on, you don't just buy growth, you should buy earnings, and then you should consider how much that stream of earnings is priced, and how much of that earnings is also being streamed back to US dividends. Now, in the case of Chinese banks, I think they pay roughly about 30% payout ratio. Yeah, but because of where they are trading at right now, I think something like 5 times P, in some cases even less, that 30% payout represents a very decent dividend yield. Yeah. In some cases, 7 to 8%. Now, if the earnings don't fall through, then you will still get a very decent dividend yield every year. If you can hold it, if they can sustain that for the next 3-4 years, then you're going to be in quite a good position a few years from now. Yeah. Yeah. But I think that volatility will still be there because the negatives are not going to go away anytime soon. And as they hang in the air, I think there's a lot of fodder for people who will come in every now and then to inject fear into the market. Yeah, and a lot of these could be hedge fund managers who have taken a short position, for example.
Well, but thanks to you, we're now in a better position to kind of interpret and understand, where that is coming from. Thank you so much, Sunam, for answering these questions. We're coming towards the end of our interview session, but before we finish, I'd just like to kind of get back to you on the poll questions that was asked earlier during the main interview session with Sunam. So the first question being, do you think China will achieve the growth target of 6.5% for this year? So good to know that I think people have been listening to Sunam. They are swayed by what he's saying. Yes, 60% voted that China will hit its growth target, with the remainder of 40% saying that it wouldn't. As for the second question, in terms of where oil prices will be headed, whether it will stay at the less than $40 range, between the 40-60 or more than $60 range, again, overwhelmingly, 80% of you feel that it will stay within the 40 and 60%, the new kind of equilibrium channel that Sunam was talking about, and about 20% of you feel that it will fall below $40. Thank you once again for spending your lunch break with us. But before you go, I'd like to get your feedback on today's seminar. All you have to do is answer 2 simple questions on whether you like the webcast and whether you would tune in to similar investment webinars in the future. You can answer them in the same Q&A box where the polls were. And if you have other comments and suggestions, we would love to hear from you as well. Thank you once again for being here with us, and thank you, Sunam.
Thank you, Jim.